This past May, Wall Street bought about $7 billion worth of Catastrophe. In 1 month. 20 separate deals, the largest month in the history of the market that trades in disaster. Records fell all spring.
Bought Catastrophe. Who wakes up in the morning and buys a hurricane?
Pension funds, mostly. Quiet, careful money. And here's the part that should make you sit up. Some of the risk they're buying is the risk of your house burning. The instrument is called a catastrophe bond. Today, how one is built, why the smartest money on earth loves them, and what happens when one explodes.
Last episode you showed me the chain. My premium goes up through the insurer to the reinsurer, and at the very top the risk becomes a bond. I followed the chain. I still don't understand the bond. Who signs what?
To understand the paper, you have to meet the storm that created it. August 1992. Hurricane Andrew crosses Florida. $27 billion in damages, $15.5 billion of it covered by insurance. Numbers nobody had modeled. 8 insurance companies fail outright. Others are pushed to the brink. The industry drew a hard lesson. For the true tale, the worst year in a century, there simply isn't enough reinsurance capital in the world. So somebody asked a dangerous question. What if we could sell the tail? To the bond market? The first small, experimental deals appear in the mid-90s. Then June 97, the deal that proved it. USAA came to market planning an issue of around $100 million of hurricane risk. Investor demand ran near $1 billion. They placed $477 million. The template was born.
Okay, so how is one of these actually built?
3 pieces. The insurer, the sponsor, sets up a special purpose vehicle, a shell whose only job is this one deal. Investors wire in the principal, and that cash doesn't go to the insurer. It sits locked in a collateral account, parked in treasuries. The investors collect a coupon, the treasury yield, plus a risk spread the sponsor pays. And then there's the trigger, the heart of the contract. If the named disaster crosses the named threshold during the bond's life, the collateral is released to the sponsor to pay claims. If it never does, investors get every dollar back. The trigger can be the sponsor's actual losses, an industry loss index, or a pure physical parameter, wind speed, ground shaking.
So if nothing happens for 3 years, they just collect the coupon the whole time?
The whole time. That's the deal, getting paid to hold the one risk everyone else on the planet is desperate to get rid of.
But wait, the sponsor is trusting a shell company and a crowd of investors to actually pay up after a disaster? That sounds shakier than a normal insurance policy, not safer.
It's the opposite, and this is the elegant part. With ordinary reinsurance, the sponsor is holding a promise, a reinsurer who might, in one brutal year, not be able to pay. Here, the money is already there. It's sitting in that collateral account, in treasuries, before a single storm has a name. Fully collateralized, there is no counterparty left to fail. That's a real reason this market grew. For the sponsor, the bond is often safer than the reinsurance it replaces.
Paid how much?
The market's benchmark index tells the story. 2023, 19.69%, the best year in the index's history. 2024, 17.29. 2025, 11.4. 3 double-digit years in a row, fat treasury yields, plus the spread, and no mega disaster reaching deep into the market. And who's collecting those coupons? The single largest investor in this market is a manager called PGGM, investing on behalf of the pension fund for Dutch healthcare workers. Nearly $9 billion riding on insurance risk. It returned 12.4% last year.
So a nurse's pension in Amsterdam is riding on whether California burns?
And that's precisely the pitch. Catastrophes don't read the financial pages. When stock markets crash, hurricanes don't notice. When a hurricane hits, stock markets mostly shrug. For a pension fund, an asset that moves to its own weather is diversification gold. Which is why the money keeps coming. First half of this year, almost $18 billion of new catastrophe bonds, a record. The market outstanding hit $65.5 billion. 9 brand new sponsors showed up in a single quarter.
Who are the sponsors?
Insurers, reinsurers, government programs. Here's the actual transaction list from the market's quarterly report. June of this year, a German insurer, Gothair, placing $114 million of German flood risk. Every line on this page is somebody's disaster wearing a ticker.
So everybody wins. The insurer gets capacity, the pension gets its yield. Where's the catch?
The catch has a name, Mariah Re. 2011, American family, a Midwestern insurer, sponsors a $100 million bond against severe thunderstorms and tornadoes. The trigger is an industry loss estimate published by a modeling firm, Air Worldwide. The threshold, $825 million of industry losses. Above that line, investors start paying. That spring becomes the deadliest tornado season in American history, Joplin, Tuscaloosa. The estimates climb all summer. By the end of October, $836 million. The line is breached.
So the investors are already losing money.
Some, and then comes November 28th. The modeling firm re-examines one storm in Kansas and reclassifies it. Non-metro becomes metro. Different loss factors. The estimate jumps to $954 million. The principal goes to zero. All $100 million flows to the insurer.
Hold on. One word changed, and $100 million of pension money evaporated?
The investors thought the same thing. They went to court, and the court said, "Read your documents, they are unambiguous." The fine print held. And honestly, that's the moment this market grew up. A catastrophe bond is not a lottery ticket, it's a contract. And the contract, every clause of it, is the whole game.
Is that why January barely moved it? The Los Angeles fires, the whole market lost, what? Under $250 million?
Reported well under $250 million on a market of more than $60 billion, most bonds sat far above their triggers. Most years, this machine just hums. But every investor holding these notes also holds the Mariah Re lesson. Before you admire the coupon, read the trigger clause. So here's what I want you to keep. Insurance ran out of room, and the overflow became a security. Your premium is part of a coupon stream. Somebody's pension is the collateral behind your rebuild. And between them sits a trigger clause that decides everything, written down, filed, and readable.
Somewhere out there, my house is inside a bond.
A slice of it, almost certainly. And that's not a scary thing. It's how a $65 billion shock absorber works. But now you know the machine's name, and you know where its fine print lives. Next on this channel, the meter, the AI data center boom, and who actually ends up paying for it. And after that, back here on Uninsurable, Fair Plans, the insurer of last resort, and what happens when the last resort starts running out of money. I'm Marcus Reeve. I spent 30 years reading the fine print.
And I'm Nora Vance, off to find out which bond my house is in.